Company in focus this morning is Allcargo Group. We've got Allcargo Logistics, pardon me, and Ravi, Jakhar, Chief Strategy Officer, joins in and take us through how the quarter's been. The stock, as we see it, is up about 2%. Hi, Ravi. Good morning. Great to have you on the show. Ravi, just like
It's
we
a
were
pleasure.
discussing this before we went live, when I said the earnings are slightly below what we saw in the same quarter last year, but you, of course, indicated that there is a recovery that's underway sequentially. You want to walk us through that, and for the sake of our viewers, also break it down for us?
Yeah, so, just like you were having a conversation a while ago, last quarter we had mentioned that we believe that the scenario has bottomed out, and that's what we are seeing. In the international supply chain business, you would notice that there's been a marginal improvement on EBITDA on a sequential basis. We do not see any dramatic improvements immediately because the global trade remains subdued. However, global economic indications are clear. The rates are likely to be cut over the next 3 to 6 months, which means that inflation being under control, the consumption should go up and the global trade should, rebound. So all these symbols are pointing towards a rebound in global trade in the second half of calendar year 2024. And our international supply chain business is very closely tied to the global trade. So we expect the second half of 2024 calendar year to be good. And before that, we have taken a lot of cost initiatives as well. We have rationalized costs by digitizing certain job roles, by outsourcing some from high-cost countries to low-cost countries. Now, the impact of that on an ongoing basis should reflect from January onwards, but the Jan to March quarter would then also see some amount of severance. So overall, from a financial performance perspective, expect April to June quarter to be better. And then from July onwards, we expect it to be much better based on the improved revenue, improved volumes, improved margins, and at the same time, costs, like I mentioned, because of a variety of initiatives we have taken, would not grow in sync with the revenue. And that would provide the operating leverage and profits to improve. That's the expectation at this point in time, based on our outlook for macroeconomic environment.
Right, Ravi, I'm glad I caught you today because there have been some global data points that are not really indicating to growth recovering anytime soon. So Japan, for example, has slipped into a recession. They've actually degrown this quarter. Singapore's GDP has also come in lower than what the street was working with. The US, of course, the hopes of a rate cut have been pushed down the road. Now, all those factors point to the fact that global demand recovery or consumption will only come in to play maybe 6 to 8 months out. So are you still confident that over the next couple of months, the revival will play out for you?
No, so like I mentioned, we are not expecting an immediate revival. So there have been two views on this. Some people expecting an immediate revival, but we have been maintaining that based on our experience at the ground level and looking at the economic forecast, we believe the revival to be in the second half of the year, which is from July onwards. And we believe that some of the economies, whether it's parts of Western Europe, Japan, or to that extent, the consumption in US as well, is likely to remain muted for the next 2 to 3 months, as you're also indicating, and the recent data also pronounces that. But we are still hopeful of a rebound in the second half of the calendar year. So we maintain that.
Right. Ravi, can you talk us through capex, if at all, and in terms of fleet expansion, do you guys have any plans on the anvil going forward, and perhaps some timelines with respect to this?
So as you know, our business is completely asset light. So what we run is more like a phygital network, wherein we have a digital backbone which connects the entire network, and we operate the world's largest LCL trade lane network with more than 2,500 trade lanes. But when it comes to assets, this is on the back of warehouses which are operated and leased. We do not own them. It is on the back of ships which are owned by a variety of shipping lines, and we again do not own those assets. So therefore, from our perspective, it's a completely asset-light model. Even on the domestic side, we operate almost 5,000 trucks which run for Gati every day on the roads, but we don't own any of them. So the business is completely asset-light, and therefore, capex requirements are only to the extent of digital initiatives, investing into systems, technologies, and to some extent on the domestic side, we would have some investments going into the soft infra inside the hubs for the Gati business. But overall, in terms of the scale of revenue and business, we do not see any significant capex on the international supply chain or the domestic business either.
Right. Ravi, in light of that, in light of your lease agreements, does that substantially change when you do have a little bit of moderation in economies across the globe? Does that have an impact on your costs? Do they increase? Do they decrease? How does that pan out?
So our cost procurement is quite dynamic, and it is in sync with the demand. So we work with global shipping carriers to plan the demand based on consumer, for us, that's a freight forwarder. And we are quite flexible in terms of how we're able to plan our capacity. The only thing which happens is, when the macroeconomic environment is subdued, our utilizations can go down. So, for a 40-foot container, in good times, if you're carrying, say, 57 cubic meters of cargo, when the economic recession is there, maybe we're carrying 54 or 55. And to that extent, some amount of cost optimization goes away. And that's why I'm saying when the economic environment rebounds, we should see improved utilization. And on back of that, we should see improved margins. But are we taking any cost risk? Like, are there containers that are being booked, which we have to pay for even if the customer is not there? Those situations don't arise because we have dynamic models which allow us to have flexible capacity with our back-end carriers that we operate with. So in that context, there's no price risk, but obviously macroeconomic environment impacts the utilization and therefore the optimization and hence the profitability.
Ravi, this may be a little forward-looking, but if you can just guide us in terms of what sort of EBITDA margins do you think we can expect from Allcargo in calendar year 2024? And I also want to ask you, you said there has been operational efficiency, which will, of course, impact the company positively, and you will be undertaking more of such drives over the next few quarters. Can you quantify that for us? What sort of impact in basis, in percentage points, can we expect that to impact your earnings?
Yeah, so I would say, if you look at our overall staff and general administrative costs, we are looking at reductions which would be almost to the degree of, I would say, touching double digits. So what this means is that if we take into account certain inflationary increases which happen, there's a constant increase in terms of investments in people, etc. Now, all of that typically would not add up to a double digit, and therefore we should be able to contain all the escalations in costs which are required for the general business growth and inflation, and which means that whatever positive movement happens on the gross profit on account of volumes, on account of improved operating profitability, should all come down to the bottom line. So that's the broad expectation we have. And when I say cost reduction, it basically allows us to contain the costs, and we are quite hopeful of that.
Ravi, you also mentioned that with all the corporate restructuring that's underway, once the execution of that is completed, which will be towards the end of this year, we will see a positive contribution of that to your top line. Can you quantify that for me? Can you tell me how much impact, maybe from the second, third quarter of FY25, can we see in terms of your top line on back of this corporate restructuring?
Yeah, so if you look at the corporate restructuring that we have undertaken, it's likely to conclude by December 24, January 25. What that would do is international supply chain business would get demerged into a separate entity and be independent. The bigger change happens on the domestic side. Today, we have express business operating in a step-down subsidiary of Gati, which itself is a subsidiary of Allcargo. We have contract logistics business in another wholly owned subsidiary. Now, all of that goes away and it becomes one single operating entity, which is directly listed. So all the holding inefficiencies go away. Secondly, you need to have, in some sense, additional management bandwidth as well when you have such complex structures. So all of that also goes away. The third part is, from a customer point of view, express and contract logistics cater to the same segment. These are companies looking at largely fulfillment logistics, which comprises both warehousing and express. Now, as these two businesses operate as one team, one entity, there would be a potential to get increased share of wallet from our express distribution companies and also do a cross-selling between the express and contract logistics business. So therefore, we expect that there could be, I would say in terms of quantifying the number, it could be something like 4 to 5% additional revenue could kick in on account of synergies. And then there would be also some degree of cost optimization, which would happen as two businesses which are so synchronized with each other come together into one organizational setup. And then all the eliminating the inefficiencies of the corporate structure. So that's what the scheme would do, make things very simple and create two independent businesses, one on the international supply chain and second on the domestic logistics.
Right. Thank you, Ravi. Great having you on the show. Thank you for explaining to us and reading through those numbers with us. Allcargo, remember, has been the news on back of the corporate restructuring. The stock was very active at the start of this year. Even as we see it, it's actually at the day's high point, trading with a gain of 2.6%. Well, moving on from one company to another, we've got with us Mr. Jadeja, Chairman and MD of Jyoti CNC Automation.